Welcome, Washington, D.C. Metro, to Ryan Sloper's Real Estate Radio, the most important hour of radio every Monday on 15 a.m., The Big Talker. Thank you for joining me this afternoon. For those of you who don't know, Real Estate Radio is a show dedicated to building the Washington, D.C. Metro's housing and credit markets. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted advice. That is my message. I'll be delivering it to you guys every Monday right here from 2 to 3 p.m. on 1580 a.m., The Big Talker. I want to remind you guys, if you ever have any questions, credit-related, housing-related, you're looking to buy, sell, or refinance, please reach out to us on our off-air number. It's 877-245-2030. It's 877-245-2030. We've got a ton of stuff to cover today. There's a lot going on. Basically, I know everybody's heard about the flooding that's taking place. That's, terrible. They said it's some $5 billion worth of potential damage down there in the coast of Mississippi. Joining us on our panel today to discuss a lot of the current events and what's going on in the market from last week is Louis Cammarosano, who's the general manager of HomeGain, and you can check them out at homegain.com. Louis is, he's one of the real estate industry leaders. He's consistently ranked in Inman News top 100 most influential real estate leaders in the technology category. Louis, you there?
Hi, Ryan. How are you?
I'm doing well. How about yourself, Louis?
Excellent, thank you. How's your little one?
My little one is doing well. I was telling somebody earlier that he is, he's picking his neck up all over the place. It's kind of scary. He's like throwing himself like off my chest half the time. I'm having to make sure he doesn't jump out of my arms. But yeah, he's doing great. I'm, it's day by day. I'm just learning new and more things about myself and him. Outside of that, everything's going well. How was your weekend?
It was very good.
We got a lot going on. We got the Mississippi that flooding that's saying it's causing a potential up to $5 billion to rebuild. I mean, they don't even know because it's not the end of it yet.
Well, there's also crop damage too, which is
yeah. We got that. Also, the bigger news of the day to me, I mean, this is something we've been talking about for a while, is that the actual debt ceiling has been basically hit. Geithner came out and told Congress that basically we have, reached the cap of the amount of debt that we're, able to go, and that he says that there's a bunch of loopholes that he can probably drag this out for another 11 weeks or so. But he said that's it. If lawmakers don't get it together by August the 2nd, the United States will no longer be able to pay its bills in full, which would mean that somebody is not going to be receiving interest payments, or they're going to just start to determine who gets money first and who doesn't get it, right?
Well, also what's interesting, Ryan, is that then they'd have to raise interest rates to make the issuance of new debt more attractive from the Federal Reserve. But what the other thing that's interesting is the call is always just to raise the debt ceiling, as if that's the matter of course that we've gotten into, rather than cut the spending so that you don't have the debt come up against the debt ceiling.
Right. Yep. And it seems like, they intentionally, it's like, why have the debt ceiling? I mean, it should be something that's put in place so that, you don't get near it. I mean, it's just something that they just continue to increase every so often. And really their intentions are to never to cut their spending back. I mean, this has just been going on for, since the 60s at this point.
Right. It's actually to the point now where it's a matter of course, and somehow you're extreme and radical if you don't want to spend more than you're supposed to be spending.
Right. And I was reading another article in CNN Money which said that China's Treasury holdings are at $1.14 trillion. And they've been decreasing for the last 2 or 3 months now. This is something that I don't think a lot of people have paid much attention to, but it has huge implications because they're basically one of the top 2 largest countries of buying basically U.S. debt.
Well, they're concerned that we can't pay it, so they don't want to keep buying more. But the problem is if they don't buy more, then it's kind of a catch-22 because we rely on that money also to pay back on the interest.
Right. And
in other words, we get new money coming in from sale of principal amounts of the Treasuries, and we use that to pay the interest on them. So it's almost like they can shoot themselves in the foot if they stop buying them. They're almost kind of caught in this symbiotic relationship where they have to keep buying, but they know at some point they're going to have to cut back, and they're going to have to maybe take some losses in their Treasuries. And when they stop buying, then the only option is we have to cut spending. We won't be able to fund all of our spending through the purchase of debt by the Chinese. And we're going to have to offer higher interest rates to get people to buy them where the Chinese won't buy them.
Yeah, I thought it was interesting in this article. It had actually mentioned how many times the ceiling has been raised. Since March 1962, the debt ceiling has been raised 74 times.
So why have a debt ceiling?
Exactly. 10 of those times have occurred since 2001. So even as of late, it's just getting worse and worse. And I mean, it's currently set at $14.294 trillion.
Which is the largest debt ever incurred by any nation in history.
It's insane. And just to say those numbers, $14.294 trillion.
And then the problem is, Ryan, if you don't increase it, there's something wrong with you.
Right. I know. And you know what bothers me the most? I mean, we're sitting here, Real Estate Radio is all about providing solutions to the consumers out there. And the people that are in debt up to their eyeballs, ultimately, what do they have to do if they can't pay their bills? They have to go through a bankruptcy or they have to work through that debt. We are not willing to do anything but continue to raise a ceiling that should have never been there to begin with.
But Ryan, that's like if you owe money on your credit card and you have a $25,000 limit, you just keep getting the credit card company to give you more credit. They're not going to do that.
Right. Yep.
They know you can't pay. They don't raise it to 30 and hope that somehow you're going to be able to pay it now that you've increased it to 30.
I know.
If that doesn't work, go to 35.
That's very true. But as I've talked about on this show numerous times, they're not raising anybody's limits anymore. The only limits that are being raised are the government's rates. You know what I mean? The amount of money the government can spend continues to rise. The amount of credit available to consumers out there is dwindling.
Well, there's also, Ryan, a false theory that somehow if you do spend more money, even if you owe more money, that somehow it's all going to work out in the end. And that seems only to apply to government finances. That we need this money in the system to stimulate the economy.
That's true. A lot of the listeners have been asking, will reaching the debt ceiling actually cause a government shutdown? And it's interesting. Not technically, it probably won't, because what will happen is they'll probably just appropriate money, for certain agencies to stay open, and probably, they'll might determine that their interest payments go one place and not another. So I don't think it'll completely shut down, but it could be a partial government shutdown.
Right. The partial government shutdown, so how I understand it, is they cut the discretionary spending.
Right.
The essential services stay in place. The FBI, the checks for Medicaid, for Social Security, all the things that require writing checks there. But, for example, I think the Department of Energy closes, the Department of Education closes, but apparently they still accrue the salaries for the people, so they're on paid holiday. So you really don't even get the savings when they close the government down.
It's not too shocking there. We're gonna jump into this week's Word on Wealth. This segment was brought to you by HomeGain. HomeGain is the place to get you started buying or selling a home, finding a realtor, and getting real estate questions answered. So go to homegain.com today and see what I'm talking about. All you have to do is type in your home address, and you will get an instant free estimate of your home's value online. It's a great way to monitor your home's value, and it's totally free. So, guys, when you get a chance, check that out today. It's homegain.com. So this week's segment, Word on Wealth, we're going to give you guys an overview of what happened last week in the market and anything that impacts you, the consumer, financially. So last week was a pretty mild week. Last Monday, Zillow had reported 28% of homeowners are underwater, which is really news to not anybody, because we know that, majority of the country is still struggling with their home equity positions and not being able to have options to either sell, refinance, or really modify or do anything with their loans. And I do want to emphasize, this is something that I think is important, that one of the making home affordable refinance plans that has been out there, I know a lot of people know about that, and they're trying to figure out whether they qualify for that or not. It did get extended from basically April, so now it's the new expiration date is June 30th of 2012. Now, I know, and I've been telling listeners all day long that these probably don't help that many people. However, the people that it might help, which is a small percentage, let's say it's 0.5% or 1% of the people are out there that currently have Fannie Mae or Freddie Mac backed loans, that you still could potentially fall into this HARP plan. So since they have made the extension until June 30th, 2012, you do want to check in to see if you are going to hit these. Now, there's 2 points that you have to qualify for these two things, and one of them is only Fannie Mae and Freddie Mac backed loans are HARP eligible. And number 2 is your current mortgage must have a securitization date prior to June 1st of 2009. If you do not meet these two criteria, you are HARP ineligible, period, end of story. And that's why I say it eliminates so many people, because it's just, almost just really a 2-year time period that you could fall into that. Now, how you find out if you're eligible through Fannie Mae or Freddie Mac, you can check both their websites. Both Fannie Mae and Freddie Mac have posted lookup forms on their respective websites. You can check Fannie Mae's first because Fannie Mae has a larger market share. And if you don't find a match there, then go to FreddieMac.com, and they have a form. You can enter in your address, social security number. It will tell you if they own your loan. Now, I bring this up because if you do fall into the category and you are eligible, that you can actually refinance and get into there. Like if you don't currently have mortgage insurance, they'll lower your rate and give you another loan without mortgage insurance. So for the people that it would apply to, I would highly suggest you reach out to me. I can help you, go through the whole process, look online, find out if your current mortgage is going to fit underneath this criteria. It's 877-245-2030. That's 877-245-2030. And we'll touch on some other of those questions, some frequently asked questions on this program later in the show. But moving ahead to Tuesday, which the National Fed of Independent Business report, business confidence is at a 7-month low. And one of the major questions I have for everybody out there, would you hire in this marketplace? Or would you just basically keep the workers you have and give them more hours, try to get more productivity out of the current workers that you have? I would say, Louis, you and I have been discussing this over the last couple months, and obviously I think me and you agree that that's probably what we would do before we went and hired new employees. Would you say that's probably true?
The question isn't hypothetical to me because I am in charge of hiring employees, and that is exactly what we're doing. In fact, what we've done in many instances is we've retooled certain employees and given them promotions to work in other areas where there isn't as much work in one area, they can do work in another area. So we're getting more productivity out of our existing employees.
Yeah, I actually saw an interesting article where they were kind of showing where, the best job growth has been over the last year. And the number one category, which is probably no surprise, is healthcare. The number two category was government. That's a shocker, right? And then number 3 was education. And it was actually private education, which I thought was interesting. But it seems like the education costs are shooting through the roof. And obviously, I guess they're doing that. They can continue to hire more workers as long as the tuitions and room and boards are going up.
Although I did see when they released the employment numbers that the government jobs were down at the growth in employment in the last numbers they released were in the private sector. And that makes sense because the states are doing layoffs.
Yes. Because
they don't have the ability to print money to cover their expenses, so they're forced to cut heads. The federal government appears still to be growing, though, those government jobs, and that's helpful in the D.C. metro area for housing. Yeah,
we've talked about that numerous times. I mean, one of the big things that we do have going for us in this Washington, D.C. metropolitan area is big government. I mean, their jobs are all over the place. The government contractors their offices are getting bigger, they're look like McMansions on the side of the road. You'll be driving down the street, you'll look over to the side of the road, you'll see houses, and all of a sudden it's just this huge independent building, and it's just government contractor, and they're just building one after the other. A lot in the suburbs of actually Northern Virginia. So I can definitely vouch for, government is getting bigger and bigger here. Federally speaking, I do agree with you that the local and state governments are having to make cuts because they don't, they can't make basically the budget work. I know we talked about before one of the states, New Jersey, that was actually shutting down projects, big projects that would, I guess Obama would assume that would help things just because the infrastructure and all that, but New Jersey made the decision that we don't have the money to spend, so we're not spending it, which is logical. That's the one thing that our federal government decides they don't do. If we don't have the money there, we'll spend it anyway and worry about it later.
Right, because they don't have the same limits that the states have on them.
Exactly.
And the states are also relatively limited on how much they can tax their citizens because the citizens can go to another state. The federal government, although they haven't done it yet, can raise taxes a bit because people probably aren't going to leave the country unless the tax rate was ridiculously high. So the federal government has the ability to raise taxes, has the ability to continue to increase spending, whereas the states don't have that option.
Yep. Let's move ahead to last Wednesday where the Mortgage Banker Association's Market Composite Index, which is a measure of mortgage loan application volume, increased 8.2% in the latest week. Now, what that means to you, the consumer out there, basically means that more people are looking to buy homes. And not to mention that with interest rates being lowered, a lot more refinance people are out there seeing if they can get this, this last second refinance in. I mean, I've honestly, Every time that I've said that I don't think they can go lower, they've just inched a little bit lower, and it has a lot to do with the world events that are going on, what oil prices are doing. We have the flooding, the natural disasters. These all cause money to move out of stocks and into mortgage-backed securities, which is the safe haven of bonds there. So when these yields rise, mortgage interest rates do go down. I would highly emphasize, if there is anyone left standing that hasn't done a refinance yet, whether you're looking to lower your payment or whether you're looking to reduce your term, maybe from a 30 to a 20 or from a 30 to a 15, that you highly consider doing that. I mean, the rates are, basically at a year lows. Right now, I believe it was Bankrate was quoting the average 30-year fixed. This past week was 4.59% from the previous week, which 4.67%. Remember, everything that I'm quoting depends on your qualifications, and anytime you're shopping for interest rates, make sure you look at APR. That's the best way to tell what one person's closing costs are versus another. The 15-year fixed was at 3.82% average, up or down from 3.9% from the previous week. And for those people out here that are only looking to move and stay in a home for 5 years or less, the 5-year adjustable rate mortgage was 3.17%. That was the average, down from 3.2% the week before. So obviously the loan volume is going to increase anytime interest rates drop down like that. It doesn't necessarily mean that many more people are buying houses. So I do want to clarify that. Last Thursday, the jobless claims were measured, and jobless benefits decreased 44,000 in the week ended May 7th to 434,000. The Labor Department figures showed that. Economists had forecasted 430,000 claims, according to the median estimate in a Bloomberg News survey. The number of people on unemployment benefits rose while those getting extended payments decreased. On Friday was the big measure of inflation. Inflation, remember, guys, is the arch enemy of interest rates. So anytime we're here, bad inflation number, it basically means that we can look to potentially see a rise in interest rates. After weeks of high gas prices, if finally the oil prices had dropped back down, everybody is hoping that with oil prices dropping, that gas is going to soon follow. Not really sure that I tend to agree with that. Coming into the summer months, I think that we are going to see a spike back up. They tend to always take advantage of people, especially in the summer travel months. Inflation rose, let's see here, consumer prices rose 3.2% for the year ending in April, the most since October of 2008. Higher food and gas prices drove the gains, obviously. If you exclude those two categories, prices rose 0.2% in April. We talk about this almost every other week, Lewis. What's the biggest, the most amount of money gets spent on food and energy, gas.
And those are the things they want you to not to pay attention to when they consider what the inflation rate is.
Absolutely. And as that affects housing, I mean, people have less money to put towards their mortgage payment, their rent payment, if they're having to spend more money to get to work.
Or to even, to save.
Or to save. They don't have money to save for a down payment, so, it's putting them in a catch-22. And the Fed, they keep talking about how all these costs are transitory, and they get so fixated on this, and it's driving me insane that they keep saying this.
Well, define transitory. It could be 2 months, 2 years, 2 decades.
Exactly. And right now, we have interest rates that are being kept artificially low, in my opinion, because if they were all of a sudden to rise to 6%, I think we can all assume that the housing market would collapse all over again. But, it's just, how long can this go on? How long can the interest rates stay artificially low? I mean, we have inflation. We have commodity-based inflation with food and energy prices. And at some point, it's going to have an effect even here in Washington, D.C. metro area. I know people have been moving in. What's interesting, I actually had a client call me about 2 weeks ago from Michigan. And I want to say the salary was probably somewhere around like $30,000 in Michigan. He was like, I'm looking to relocate into the area, and I wanted to find out what I could get mortgage-wise. And I said, okay, well, let's go ahead, get your credit pulled up, look at all your qualifications, check out your short and long-term goals. And I was like, okay, so you're moving in here, and he was going to basically get a raise from about $30,000 up to about $65,000. And I'm thinking to myself, okay, he doubled his pay. But when he started looking at the sticker shock of what it costs to live here, I was like, I think that, really that increase in pay only maybe went up by about 5% or so, just because of how much the rent, potential rentals are. And even if he got a mortgage, even if he could get into a first-time home buyer program here, he's still going to have a pretty large mortgage payment unless he move further south. He was going to work in the Northern Virginia region for another government contractor. And, after doing all the math, he's like, well, I don't know. I didn't know that it was that expensive here. And this is so true. I mean, a lot of the times you get so fixated on the numbers, the actual dollar signs of the salary, that you don't pay as much of attention to where you're moving.
Well, what's interesting, Ron, I'd like to know, I've never seen any movement whatsoever. When the federal government fixes tax rates, they don't give any consideration whatsoever to what part of the country you're in. They say if you make $200,000, you're making a lot of money, and you're taxed at X rate. But that's not true if you live in certain parts of New York, California, and the East Coast.
Absolutely. I mean, I'd venture to say that, I mean, if you're living in certain parts of Northern Virginia, that $200,000 is near as much as what people think it is. I mean, I would think that closer to the $500,000 range, you're probably living pretty happy. But, when we just start talking about millionaires and that, this and the other, but around here, Falls Church and the high-end areas, I mean, that's not that much money.
Yeah, so when they throw those numbers out, they mean something to somebody in Alabama, and they say, sure, tax those rich people. But with the people living in the northern D.C. metro area, two workers making combined salary $250,000, they may not have to cry for their supper, but they don't have a lot of discretionary disposable income after that. They're by no means, in my mind, rich.
Yeah, very true. You're listening to Real Estate Radio. I'm your host, Ryan Sloper, joined by Louis Cammarosano, the general manager of HomeGain. Louis, I have a question. I know you follow the market. What do you think is in store for oil prices through the end of the summer? I know a lot of our listeners have that question. They're all trying to figure out planned family vacations and see what the best courses they're going to fly or they're going to drive. What do you think they're going to do? I mean, it seems we've had a drop, but where do you think they're going to go?
Oil prices are difficult to figure out because you have whatever OPEC decides to do with the supply. You have
speculators.
The general issue with the dollar, what the direction there is and how that impacts the price of oil. But the other thing we haven't discussed yet today is, were any oil refineries damaged as a result of this flood? Because that also could impact short-term supply as well.
As of last night, I heard that they were all fully operating. There was one in one region that they said they might have to shut down, but as to my knowledge, they're all operating as of right now.
I would expect you're right that the demand will rise in the summer months. That if they can control prices to the extent on the upside, they will try to do that. And of course, you're always going to have these shocks in the Middle East. There was something yesterday in Israel. There's always something. So I don't expect oil prices or gas prices at the pump to come down significantly below the $4 range in the California area in the next 3 or 4 months, even if the per barrel price comes down below 100 and stays there.
Yeah, I agree with you 100% there.
And also, Ryan, the local entities or the states enjoy when the price is up because you get more tax revenue.
Yep, that's very true. And I mean, every state has different tax bases on gasoline anyway. So
the higher the price, the more money they make.
Exactly. I mean, I've actually heard a story where everybody's thinking that the gas stations are getting fat, happy, and rich by raising it up, but they're not making as much money as everybody thinks because of, you have credit card transaction fees. Their margins, they say, most of the time are between 10 and 20 cents. And by the time you take into consideration all the fees and then them having to keep their gas even to what the guy across the street is charging, depending upon when they got their last gas fill up, they're not making as much, but you start looking at the Chevrons and their yearly and quarterly profits, they're out of control.
Well, the gross amount is out of control, but if you look at the gross margins on a percentage basis, they're not at the same levels of, say, Google and Microsoft.
Right.
Yep. I mean, you do have a lot of work that goes into producing the oil. There's a lot of overhead costs. So they make a lot of money, but they also produce an enormous amount of oil.
Yeah.
And refine.
You're listening to Real Estate Radio. I'm your host, Ryan Sloper, joined by Louis Cammarosano. Louis, stay on the line. When you come back, we are going to jump into whether now would be a good time to move up. If you're currently living in a home and looking to, upgrade it to a bigger house or move into a more desirable area, is now the time to do that. Stay right there.